Arvind, how are you adopting your strategy to current volatility that we're witnessing globally? And specifically when it comes to India, how do you feel foreign investors are perhaps changing their stance? And do you see this further accelerating in the weeks and months to come?
So, on a global portfolio, we are very overweight anything related to energy. The world is short energy. India is having power shortages. Coal is in short supply. Europe is having power shortages. Natural gas and coal are in short supply. U.S. natural gas prices are at 14-year highs. So the world is extremely short energy. It is extremely short other resources. Base metals would be doing much better if it were not for the China lockdown. None of these problems have a magic wand solution, and energy transition and ESG only makes the problem worse. So we think that's a theme that's going to be around for a while. It's not going to, economic slowdown is not going to solve the energy problem. That's a global perspective. India is energy deficient. There aren't many companies that you can play in the energy space. And as we've seen from the news over the last couple of days, India has put tariffs on steel and iron ore exports and increased or decreased excise taxes on petrol and diesel, and at least on petrol. I'm not sure if it was diesel too. But the reality is that what that means is global inflation is going to keep growing up. So our view is we're staying in hard assets, real asset plays, but staying in cash in the short term a little bit, because these kind of policy moves like what we saw this weekend create huge amount of uncertainty as to where you can hide, so to speak, in this market. Right. The steel stocks were down double digits today. So we would look for buying some of these whether it's real estate, whether it's domestic infrastructure providers, whether it is a base metals, whether it's energy. Those are the kind of places we would look at, and we'd be very cautious about the inflation losers. You've seen WPI inflation is at multi-year highs in India, if not close to multi-decade highs.
It's interesting that you mentioned commodities, Arvind, because we started the year talking about a super cycle in commodities, and metal stocks were doing so well. And then metal stocks have just been hammered out of shape in the last couple of weeks. There are concerns on recession, on what China is doing, and that seems to have taken all that steam out of the low supply and commodity prices rising in a super cycle, that whole argument out completely. Do you see this as an opportunity, or do you think the commodity or metal bull run has ended?
It's just beginning. This is just a pause along the way. Nothing ever goes straight up. But the fact that in energy transition you need 3 to 5 times as much copper in electrification of cars, you need 5 to 7 times as much copper in solar or wind versus thermal power plants. So right now, because China is 35–40% of the world's copper demand, and China is going through a severe lockdown. Now, I don't think for the rest of our life we're going to have a Chinese, zero COVID lockdown. So once this ends, which I suspect will be by year end, if not sooner, we're going to see the underlying tightness in the market for commodities like copper, aluminum, steel. All of these are essential in energy transition. And China's short-term headwind is not structural. The demand for these is structural, and the supply growth is relatively very, very slow to come on.
The other segment which has got hit quite badly because of all the global turbulence and fears of a US recession is IT. Because, a few months ago everybody was talking about how IT should do well because A, it's defensive in nature, B, the demand metrics are very strong. But now the opposite is happening. Most of these Infosys and TCS are getting hammered down. For something which has been the core staple of global investors like you, how are you approaching this severe correction in IT names?
I think it's setting up for an interesting entry point. Again, there are two headwinds. One of what you talked about, which is the recession fear, and the other is margin compression. The IT companies benefited from a couple of short-term factors which came about because of the pandemic. One was obviously much more offshoring, and the second was much lower travel costs. So both of those are slightly reversing, and there is therefore some margin correction happening. But I think, digitization and the general move towards more outsourcing, which has become much more acceptable because of COVID and the remote work, is a tailwind that will be with us for a long time. The recession risk is clearly a demand. So the demand side, there's a little bit of a recession risk. On the cost margin side, there's a margin pressure. We think the margin pressure will be temporarily just adjusting back to a new normal. We think the recession risk starts to get discounted, and the outsourcing mega trend and the digitization mega trend is more powerful than whatever moderate impact that a recession would have, which would be therefore, I think, a good entry point in the next few months or weeks if we see much more pullback in these stocks.